Good morning and welcome to Financial Accounting. We will be finishing up Chapter 4 today. So as we look at our calendar in Blackboard, you can see that the Chapter 4 exercises should be submitted for grading by the end of the day today. We do not have class next Monday, as you know, and so today we are going to finish up Chapter 4. We have 4 more exercises to do, so we'll pick up with exercise 7. I have one other thing I want to talk about that is not actually in the exercises. And then almost certainly we will finish class early today. I don't see a point in moving on to our Chapter 5 early because we don't have class again for another week. Chapter 5 isn't on the exam. Chapter 4 isn't on the exam. I know that adds to people's concern or maybe brain overload if we cover too much stuff that's not on the exam. So once we finish up the 4 exercises and I talk about the final objective for the chapter for which we don't have any exercises, we will finish class early today. So looking ahead, after today, as I already said, we do not have class again for another week. So 1 week from today, we will pick up with Chapter 5. If you have other live classes, either on campus or on Zoom, those also will not meet next Monday, Tuesday, but keep in mind if you have asynchronous online classes, those could still have due dates on those 2 days, even though we don't have actual class on those days. So some asynchronous online instructors are careful to keep things off those days so that you have a bit of a break, but other instructors may not be as diligent about that. They may want to keep up the pattern of things are due on Monday or whatever the pattern is. You can see though, our first exam and the first part of the project is due no later than the end of the day on Sunday. We talked about both the project and the exam in a recent class, but does anyone have any questions, anything you needed to ask about related to either of those? Project, part 1, or the exam? Remember to open your ebook before you start the exam. If you run into a technical issue, make sure you reach out immediately to let me know. Just send me an email and I will get back to you as soon as I can. Anything else you're concerned about with the exam or the project? Well, then we might as well get started. So let's go to our first exercise for today, which is exercise 7 in Chapter 4. And I have highlighted, there's a typo in letter B. So I obviously did not make these, but I'd just like to apologize on behalf of Cengage that there's a typo in there. If I could report it somehow, I would do that. I have tried using that button before and it doesn't work for me because I'm in preview mode, I think. So if one of you wants to hit report content error and report that there's a typo in letter B, feel free to do that. But I'm not able to. So our first exercise for today is to put the steps in the accounting cycle in the proper sequence. So the title of the chapter is actually the accounting cycle, and that's what we've been discussing for really since the beginning of the semester. How does all this stuff work? So we know that the majority of the month or the accounting period is spent simply recording what happened on a day-to-day basis. And so I am going to, for now, I haven't memorize the list, but for now I'm going to say letter I should be the first thing that happens. Transactions are occurring, we're recording them, we're analyzing them, answering those 3 questions that we learned about in chapter 2, recognition, valuation, and classification. We have to know what accounts, what amount, and the date that goes on that transaction. We record it in the journal, and then we post those transactions to the ledger. So if this was a 30-day month, we would spend about 28 of the 30 days just doing that, recording what happened, getting it into our accounting records. And the process is it goes into the general journal or the journal of original entry, and then those journal entries get posted to the ledger, so our ledger accounts are all updated. At the end of the period then, we are going to get ready to close out, to do the adjustments, to prepare the financial statements, and then to close out the temporary accounts. And we saw that, how that works, we saw last class. So we're then going to close out those temporary accounts so that we're ready to start again the next period. So once we have posted all of the transactions, the events that occurred that affected the financial position of our company, we are then ready to print or produce or prepare the unadjusted trial balance. And we spent all of chapter 3 talking about the adjustment process. So we look at what's on there on this unadjusted trial balance, and we say, what's on there that shouldn't be? What's not on there that should be? What revenues have we earned this period? Are we accurately reflecting those? What are the expenses that go with those revenues? Are we accurately reflecting those? So we're going to assemble the data that we need to do the adjustments. We can then actually do the adjustments and prepare an adjusted trial balance. An optional end of spread. Okay, so I probably need to stick this in there too. I skipped this one. I don't. An optional end of spreadsheet is prepared. That would actually happen before we do the adjusting entries. So we prepare the spreadsheet. That helps us to recognize, oh, here are the entries. Remember, we saw that what that spreadsheet would look like with the 6 columns, the unadjusted trial balance, the adjustments, and then the adjusted trial balance. So I actually need to change this. We'll have to do that before. There we go. So we need to stick that in order that we would prepare. If we were going to use it, we would prepare that before we did the adjusting entries, because that helps us to see what the adjustments need to be. Now, the next thing that's going to happen is we're going to prepare the financial statements. However, we can prepare those financial statements at the same time that we are doing the closing entries, because likely those are accomplished by 2 different people or 2 different offices. Okay, so doing the closing entries is a bookkeeping function. Preparing the financial statements would be more of an accounting function, a higher level function than that. So although I'm putting them in the order that we prepare the financial statements, then we do the closing entries, it really doesn't matter where at that point we prepare the financial statements. In fact, it's probably more common that we do the closing entries so that bookkeeping can then start the next period, and then we're preparing the financial statements. I would say that's true except at the end of the whole year, at the end of the fiscal year, when we probably need to keep our accounting records open until the auditors come, because the auditors may have some additional recommendations for entries that we need in order to finish out our year. But I would suggest that during the interim period, so the monthly and the quarterly financial statements, we would move on to the next month, close out the month, move on to the next month before we're actually finalizing those financial statements. So that is the accounting cycle. As I said, this is the whole point of this chapter. So if you understand the flow of how things work in the accounting throughout the month or throughout the accounting period, then you should be all set for this chapter. Is there anyone who has any questions about that cycle? Let us move on then. Exercise 8 says the following revenue and expense account balances were taken from the ledger of Acorn Health Services Company after the accounts had been adjusted on January 31st, 2017, the end of the fiscal year. So we have a bunch of expenses, it looks like, and just one revenue account here. So these are the adjusted balances. So once we have done those adjustments, as we just finished covering in the accounting cycle, once we have done all those adjustments, we are ready to close our books and prepare the financial statements. So we are going to be preparing the income statement for Acorn Health Services. As with every financial statement, we have our 3-line heading: name of the company, name of the financial statement, and the date or range of dates it covers. Remember, the balance sheet just has a single date. All the other financial statements cover a range. So you need to say, is it the week, the month, the day, the quarter, the year, whatever. Our flow is going to be, for an income statement, we start with our revenues. I have that highlighted here. So we can go ahead and put in that service revenue. Remember, we talked about last class, these are not debit and credit columns. They are subtotal and total columns. They're just for presentation purposes. There's no other meaning to the fact that the revenues are on the right and the expenses are on the left. While it is true that revenues have a credit balance and expenses have a debit balance, that's not why we have them lined up like this. We know that the format that the book requires or requests of us is that our expenses are listed in decreasing order by dollar amount, with the exception of miscellaneous, and the miscellaneous expense should always be listed last. I'm going to go ahead and stick in the miscellaneous expense and its dollar amount. But then for the remaining expenses, we're going to list them from largest to smallest based on their dollar amount. So you can go ahead and do that. Mostly have it set up for us so that we're picking them in the order that they desire them to be. But as I already mentioned, the order is largest dollar amount to smallest, with the exception of miscellaneous, which will always go last. We've talked about this before, but I would like you to take special note of the formatting on the income statement. We've talked about the use of the columns for separating out the detail from the totals, but also I'd like you to make note of the fact that there's a dollar sign at the top of each column, but then there's not another dollar sign in the rest of that column, nor here, until we take a subtotal. Until we're doing some math to it. If you haven't already, go ahead and add up your expenses so we can get our total expenses. I added correctly. Now, we have mentioned before, if it does not say whether to use negatives or not, it generally, the software will allow you to use a negative or not use a negative. If it helps you to remember then that we need to subtract those expenses, please feel free to put in the negative in front of the total expenses. And what you should notice at this point is that the total expenses are greater than the revenues. So rather than making money, this company has actually lost money this year. How much did they lose? Looks like $49,250. Math purists would tell you that that number should not have a negative in front of it because it already says net loss. I believe the software will count it as correct whether you have a negative or not on that net loss. Let's see. So it is up to you whether you choose to have a negative there. Again, it is indicated that there was a loss because that's what we've titled over here, the heading for that line. But if it helps you to remember that that's a loss, feel free to use the negative there. Any questions about that? So this is not really anything new. It just gave us an opportunity to review the production of an income statement, to remind us what it means to have a net loss. So the title of this exercise actually gave us the heads up that this was going to be a loss, but it is a good reminder for us that when our expenses exceed our revenues, we lose money. We're going to have a net loss that will reduce our retained earnings for this period. Obviously, that's not a good situation to have a net loss, but certainly companies can continue and improve. In the last couple of years, there are companies that have been very long-standing companies with good track records who did not fare as well through the pandemic. And those companies certainly can rebound if they're able to stay in business. When we get to the end of this chapter, the last part I want to talk about, and I said we don't have any exercises related to it, that the last part I want to talk about is how do we analyze a company using this kind of financial information to determine whether the company is strong or not. Any questions, though, about exercise 8? Let's move on then to exercise 9. Again, this is good review, even though this chapter is technically not on the exam. The work that we're doing right now, these are accounting processes or techniques that you will need to know how to do on the exam. Making an income statement, a balance sheet, and a statement of stockholders' equity. So this exercise, exercise 9, has us completing a balance sheet. You can see already that there is a number, there's a number missing here. Our part of the exercise is to determine what that cash balance must be. And so this is a good reminder for us about the rule for a balance sheet. That is, it must balance assets equals liabilities plus equity. And so we'll be able to calculate that cash balance. As is frequently the case, this is not a realistic scenario. There's no scenario in which you just don't know the cash balance and you have to figure it out from what else you have on your balance sheet. So not a realistic scenario, but it is a good exercise for us to do to remind us of how a balance sheet works. And so what we're going to be doing in this exercise is looking at all of these accounts. Looks like they actually might be in alphabetical order. So normally our accounts, as we know on the chart of accounts and on a trial balance, are going to be listed in a specific order, and it's not alphabetical. It is in order according to the fundamental accounting equation: assets, liabilities, the permanent equity accounts, dividends, revenues, and expenses. This is going to be, again, a good review for us because we're going to need to go through line by line and think about what kind of account is that? Where does it go on our financial statement? You'll notice also, if we scroll down here, that the balance sheet is a classified balance sheet. So that is something that we learned in this chapter. The dividing up of our assets based on what type of assets they are, those subcategories. We have two here: current assets. We spent some time on Monday defining current assets. It's something we own or control that's going to help us to generate revenues or make money in the future. The fact that it's current means that it's going to be used up or turned into cash within 1 year or the normal operating cycle, whichever is longer. We talked specifically about what the operating cycle is. It's from the moment we buy the inventory from our suppliers till we sell it to our customers and then collect payment from our customers. That is the operating cycle. The other category that we have on this balance sheet is property, plant, and equipment. So those are these long-term or long-lived assets we're going to have around for more than 1 year. All of the property, plant, and equipment would be subject to depreciation with the exception of land. If we look down at the liability and equity side, the credit side of the balance sheet, as I think of it, we would have current liabilities. If we had liabilities that were due in more than 1 year and or would not be paid using current assets, we would have a separate category called long-term assets or long-term liabilities or non-current liabilities. And I can fill this in already. We know for this whole semester until we get to chapter 12, we're only going to have 2 accounts in stockholders' equity. We will have exactly 2, common stock and retained earnings. So let's get started. Oh, sorry. One more thing I wanted to say about the asset side. So for now, the textbook is showing us just 2 separate subcategories of assets: current and property, plant, and equipment. I just want you to keep in mind something I did mention last class, that there are other categories, including investments, intangible assets, special or miscellaneous assets that don't fit in those other categories. So as you're working on your project and you are looking at the balance sheet for the company that you chose, you very likely will see categories in addition to current assets and property, plant, and equipment. One reason I really like that Real World Annual Report project is because you see an actual company's financial statements and you see how what we are doing in class is mirrored by what they are doing. Some differences maybe. And occasionally in the project, you're asked to reflect on those differences, to look at what did we learn in class and how does your company maybe present things a little bit differently. Let's just start at the top of the list though. Well, now let's change things up. I normally go right down the list. We know we're looking for 5 current assets. Let's just look at the list and identify the 5 current assets. So what do you see there that's a current asset? Cash. Cash is the most liquid. And so we always start with cash. When we get to chapter 7, we will talk about cash equivalents. So when you look at the company that you chose for your project, when you look at their balance sheet, almost certainly, I'm not sure if I've ever seen a balance sheet that did not start with cash and cash equivalents. So for now, we're using the term cash, but in chapter 7, we'll talk just briefly about what else might be included in there. When you look at your company as you're working on your project for this weekend, just take a look at that top line of their balance sheet and let me know if it doesn't say cash and cash equivalents. I bet it will. So we don't know the balance in cash. That's what we have to figure out as part of this exercise. What else do we see that might be a current asset?
Accounts receivable.
Accounts receivable with a balance of 187.5, and that might be the second item here. Accounts receivable represents, as you know, the amounts that are due to us from our customers for the product or service that we sold to them on credit. Now, if you think about it, and we have a chapter, chapter 8, that's totally on receivables. That's the title of the chapter. So we'll spend more time talking about receivables when we get there. But the accounts receivable is a current asset. And that is true even if we have some customers that might pay us in longer than 1 year because of that concept of the operating cycle. If it's typical in our industry to allow people more than 1 year to pay for what they buy, then we would still consider that a current asset. So probably the industry that comes to mind for me is furniture. So if you think about local furniture stores, it's not uncommon for those furniture stores to have signs out front that say things like no interest, no payment for 18 months or for 2 years or till 2024 or whatever. That's the standard in the industry, that you allow people an extended period of time to pay. And so even though that receivable might not be due for 18 months, we're still going to count it as current because that's the standard in the industry. It becomes part of their operating cycle. Oops. What else do we see here that might be a current asset? Supplies, 11,200. I got to find where that's going to be. Okay, there it is, 11,200. Remember, unlike on the income statement where we said that we were going to list them from largest dollar amount down to smallest, on the balance sheet, the assets, the current assets, should be listed from most to least liquid, from closest to cash to the ones that are going to be around the longest within our current assets. What else do we see? Anybody else see a current asset? Unearned fees. So that represents the amount that our customers have paid to us, but we now owe them something. So we have to provide the product or service that they paid for in advance. So that is actually a liability for us. So since you mentioned that, though, let's go down and see if we can find where that's going to go. There it is. So I'll stick that in under current liabilities since we talked about it. Oh no, what's the number? 21,000. Okay. How about 2 more current assets?
I'm going to say equipment.
Do you think we'll use up the equipment in a year? Do we have to replace our equipment every year?
No.
Gosh, I hope not. So equipment is actually going to be a long-term asset with property, plant, and equipment. So again, since we mentioned it, I'll stick it in here. So equipment, $325,900. Remember, we talked about this in chapter 3, so this is good review. That $325,900 represents the original or historical cost of that equipment. It's what we paid for the equipment at the time we purchased it, but that's not actually how much it's probably worth today, because we've probably used up some of that value. For these long-term assets, other than land, for these long-term assets, the way we reflect that, the using up of the value, is through the process of recording depreciation. So the account that goes with that is right here. Whoops, I only meant to highlight just that one line. Accumulated depreciation on the equipment, that $186,000 represents the amount that we have used up from an accounting standpoint. It's the amount that we have recorded as expense over the entire time that we've been using this equipment. If it helps you remember, you can put a minus sign there. It's typical also, rather than just writing accumulated depreciation, it's typical to write less accumulated depreciation to remind you to subtract. So if we were to subtract the accumulated depreciation from the original cost, that gives us the book value, or the value that is left. The book value, it's also known as the carrying value. And that's what's going to be added into our assets, the carrying or the book value. So we have two more current assets, and they are right here in the middle of the list. They seem to be related to each other: prepaid insurance, prepaid rent. Those are current assets. That represents amounts that we have paid. Prepaid insurance, we already paid the insurance company, and now they're providing us with insurance over some extended period of time, maybe 6 months or a year. And prepaid rent, the same thing. We've paid our landlord, whoever the owner of the property is, we've already paid that entity in advance, and now we have the right to use that property for some period of time. And so it's an asset for us. Chances are we haven't paid our insurance or our rent more than 1 year in advance. But even if we did, maybe we had a 2-year lease on the property, and maybe we paid it in advance because the landlord agreed to give us a break if we paid up front, give us some kind of a discount. And maybe we paid for 2 years at a time. Maybe we really just wanted to secure that property and protect against any rent increases, because once you pay it, you're locked in, you've got that contract. That could have happened. We still would consider that, most of the time, we would still consider that a current asset, because that becomes part of our operating cycle. Same thing I explained with the receivable. Even if it's 18 months out, it's still part of the way we're doing business. So we're looking for one more asset, one more long-term asset. Anyone see a long-term asset there we haven't used yet? Land, $375,000. So I've already mentioned land is not subject to depreciation. So $375,000 represents the amount we paid for that land at the time we acquired it. We record it at historical cost, and we leave it alone. We don't increase the value, even though chances are the value of the land has increased. It does tend to increase over time. But on our books, we keep it at what we paid for it. We also don't record depreciation, because the assumption is that land does not lose value like a building or equipment or vehicle or something like that would. The only time we affect the value of that land is if we have reason to believe that value is impaired. What does that mean? If, let's say, they discover that there's a Superfund site right next door. You don't know what Superfund is. It's a federal fund that helps to pay for cleanup of environmental problems. the super fund money comes from taxes on things like number 2 fuel that's used to run trucks or whatever. So there's a special super fund tax that helps fund the cleanup of environmental problems. So if you own this land and it's discovered there's an environmental issue next door and it's a super fund cleanup site, your land's probably going to be worth a little bit less, right? Who wants to buy land next to a super fund site? If the area where the land is located, if something else happens to reduce its value, we would say that value is impaired. And if we look at the value of this land and say, you know what, it was worth $375 when we bought it, but something has changed and it's now worth less than that, we would write down the value and record expense on that impairment. But other than that, land just gets left alone. We put it on our balance sheet at what we pay for it, and we leave it there forever until we dispose of the land, until we no longer have it. So we can now find the total of our property, plant, and equipment by adding the value of the land to the carrying value or book value of the equipment. We can't do the current assets yet because we don't know the cash yet. Everybody good so far? So let's look down at the credit side, the bottom part, the other side of the equation, liabilities and equity. So we already have identified one of our current liabilities. Those are our amounts that we owe to someone outside the business, another entity, that we will expect to pay for or take care of this year, within the next year, and we expect to use current assets to take care of those liabilities. So we've already identified one as unearned fees. What other current liabilities do you see?
Accounts payable.
Accounts payable, $51,200. So accounts payable, as we know, is the amount that we have for stuff that we bought from our suppliers on credit and we have agreed to pay later. We'll be talking in our next chapter about payment terms. So how do we know when that bill is due? Anytime we see the word payable, we know that means it's a liability we owe, we'll pay later. So we can identify the other liability right here because it also includes that special word payable. Receivable is always going to be an asset. Payable is always going to be a liability. So salaries payable of $7,500 represents the amounts that we have accrued that we owe to our employees. We talked about that those accruals. Sorry about that. There was noise coming in from the hallway. So we talked about those accruals in chapter 3. The whole purpose, the whole point of chapter 3 was adjusting entries, and salaries or wages accrual was one of the exercises that we discussed. We can tell from the template that we're provided that there aren't any other liabilities. As we said last class, if there were other liabilities, if they were long-term or non-current, we'd have a separate category for those, and we would have a separate total for those if there was more than one. But we can tell that there aren't any others, so we can go ahead and add up our liabilities. Other typical liabilities include things like mortgage payable or loan payable. Maybe we have some long-term liabilities associated with what are called OPEBs. I'll write that on the screen. OPEBs. OPEB stands for other post-employment benefits. So we might have a long-term liability for pensions that we have agreed to pay our workers when they retire. OPEBs would include things like healthcare, health insurance that we've agreed to provide to people after they retire from the company, or maybe before they reach Medicare age or something like that. So mortgages, loans, bonds payable, we'll spend all of chapter 11 talking about long-term liabilities, and our focus will really be on bonds, corporate bonds, and how those work. We've already identified, we know until we get to chapter 12, these are the only two stockholders' equity accounts we will have. So we can pull in the dollar amounts for those if you haven't already. Common stock, 100,000, and retained earnings, 620, 300. And then we can total those and add that total to our total liabilities. And now we know our total liabilities and stockholders' equity. What else do we know then? If we know our total stockholders' equity and liabilities combined, what else do we know?
The total assets.
Thank you. The total assets, because the balance sheet, what that means is the two sides are in balance, assets, liabilities, and equity. They have to be the same. So if we know the total of liabilities and equity, we also know what the total of the assets must be. And now we will be able to do the math necessary to find that cash balance. So if we know our total assets are 800,000 and 514,900 of that amount is our property, plant, and equipment, then how much must our total current assets be? Anyone have a number for that? $285,100. And then our last step will be, so now we know that's the total of our current assets. If we know all of them except the cash balance, we simply need to subtract each one of these, the ones we do know, from the total to find the missing number, the cash amount. So go ahead and subtract those other amounts from that total. And see what you get for cash. Anybody? 72,000. Okay, so now we have constructed our balance sheet. One last comment I want to make about that before we move on to our next exercise. This retained earnings balance, just a reminder, if these amounts here were pulled from the trial balance, the adjusted trial balance, this retained earnings number would not be the ending balance. It would be the beginning balance, and we would still need to add to it our earnings, so add net income or subtract net loss, and we would still have to subtract any dividends that were paid. So they've given us the balance after the income has already been calculated and it's been closed. So what we learned last class about closing entries, the closing entries had already been done. It didn't specify that, but that must be the case because they didn't give us any other information to find that. So I just wanted to remind you, because as I said last class, that is, or maybe last week, that's one of the mistakes that people frequently make. If you do a balance sheet and the total assets do not equal the total liabilities and equity, I said the very first thing you should check is, did you use the ending balance for retained earnings? Go ahead and put my green check marks in there. Any questions before we move on to our final exercise? And as I said, I then have one more thing I want to talk about before we call it a day. Oops. Any questions at this point? Excuse me. So what we are asked to do in our final exercise for this chapter is to fix some errors that are in the balance sheet. So we are given a blank template down here, and you are going to go through what is given here in the balance sheet and create your own that is corrected. I'm going to point out a couple things, and then what I'm going to do is ask you to do this on your own. I'm going to pause the recording and ask you to complete it on your own. Then we'll come back together and go through it as needed, answer any questions. But just a few things so that you understand what it is, what exactly it is that you're looking for. When we look at starting with the heading, we have the name of the company, we have the name of the financial statement, but remember, a balance sheet should not say the period that it covers because it's a snapshot. It only tells us where we are as of a specific date. So it should not say for the year ended, it should only show the date. So when we look down here, they've already corrected that for us, but I wanted to make sure you see that as being an error in the balance sheet. Then as we look at the current assets, there's a couple things jump out at me. We've got a payable under assets. Well, that's not an asset, it's a liability. We also have land under current assets. That's not a current asset, it's a long-term asset. So it should be under property, plant, and equipment. Down here, we have accumulated depreciation. Although they do have credit balances, they're not liabilities, they're contra assets. The accumulated depreciation on the building should be with the building. And the accumulated depreciation on the equipment should be with the equipment. Net income doesn't belong on a balance sheet at all. That's an income statement line. We have a payable under stockholders' equity. Now they have done this in a very unique and interesting way so that the total assets here, 933,300, do match our total liabilities and equity. So that's an interesting approach they took. They made the numbers work so that it would still match up. But because of all of those mistakes, and that may not be all of them, but I just wanted you to see the types of mistakes you're looking for. You need to recategorize, put all of those accounts in the correct place. And as we saw with net income, it may be that they don't even all belong on the balance sheet at all. Create your balance sheet. Go ahead and use the check my work button. See if you've got all green check marks. I'm going to pause the recording to allow you to do that. I will do mine on the screen and then we will come back together and talk about any questions you have. And then cover the final item for this chapter. Okay, so now as we look at our balance sheet, we already pointed out the corrected heading with the correct date line. We have moved the current assets to the proper place and totaled those. We have moved the long-term assets, land, building with its depreciation, equipment with its depreciation to find the book value. Added up those three amounts, the book value of the building and equipment with the land, 542,000. Add that to the total assets to find, total current assets to find our total assets of 625. Then when we go down to the other side, the credit side of the balance sheet, you can see the two liabilities listed in total, our two equity accounts listed in total, added to the liabilities, and we can see that we match here. I'm going to go ahead and put the green check marks in there now. Any questions about that final exercise? excuse me. Okay, so the last thing I want to talk about, excuse me, the last thing I want to talk about to finish up our chapter. On Monday, we went over the learning objectives for this chapter. And we saw that the last learning objective, other than the appendices that we're not covering, was, and I'm just going to step over here so I can read it to you. Describe and illustrate the use of the asset turnover ratio in evaluating, whoops, nope, sorry, wrong chapter. Let me try that again. Describe and illustrate the use of working capital and the current ratio in evaluating a company's financial condition. So I told you on Monday when we went over those learning objectives that many of our chapters between now and the end of the semester will include financial analysis tools, calculations. Many of them, most of them are ratios that will help us to analyze a company's financial position, to know how are they doing as a company. We don't look at many of the calculations until we get to chapter 14. And most of what we do in chapter 14, the final chapter of the semester as we wrap everything up, is financial statement analysis. And so we'll be putting off the actual calculations until that final chapter. But in each chapter, as we encounter them, I will talk about what the measure is, how it's calculated, and how we use it, or what it tells us about the company. So this is our first encounter with any of those financial statement analysis tools. As we look at a company, we're really evaluating them in not just how much money did they make, because that's easy. We just look at the income statement, we can see the bottom line is net income, but that's not everything we need to know about the company. All companies have two main goals, and both of them appear on this current screen. The two main goals for every company that's out there are liquidity and solvency, or profitability. Liquidity means having enough cash to pay our bills. Profitability means making money in the long run, so that's looking at the income statement. And solvency means being able to pay their debts when they come due. So as we talk about throughout the semester, all of these financial analysis tools, we'll be talking about them in a couple different buckets. This one addresses liquidity, being able to have enough cash to pay our bills. This one addresses solvency, being able to pay our bills in the long term, stay afloat, avoid bankruptcy, if you will. Profitability, we'll talk about market strength, which is related to their stock, the strength of their stock, because we are focused this semester on publicly traded companies specifically. In this chapter, then, I just wanted to talk about two different calculations that are very commonly used. And the first one is working capital. So remember on Monday when we introduced the idea of the classified balance sheet, I said one of the reasons that we do that is to allow decision makers to very quickly sort out of their assets what's available right now to pay their bills. That's the current assets. And on the balance sheet on the other side, we're looking at their liabilities and we want to know, okay, what's due when? And so having them sorted into those subcategories that includes current assets and current liabilities allows us to very quickly assess, do they have enough in their current assets to pay the stuff that's due this year? Two ways of measuring that. These are not the only two, but these are the two that are introduced in this chapter. Working capital is the first one, and you can see the calculation right here across the middle of the screen. Current assets minus current liabilities. So it's going to be expressed as a dollar amount. So you might say, for example, that the company has $10,000 in working capital. That tells us how much they have. We call it, sometimes that's referred to as the float as well. So Working capital is a measure of how much do they have in their current assets that's not already needed to pay a current liability. So what if there's an emergency? What if a liability comes up that we weren't planning, an unplanned expense? It's kind of the reserve. It's the extra, the cushion that they have in case they actually need more to take care of their current liabilities. Does that make sense? So it's useful to a certain extent to know that a company has $10,000 in working capital, but there's something that's missing there because we don't know what size this company is. So if we look out the window where we are here in Olean, if we look out the window and we can see a number of small businesses across the street like the Union Tea Shop. And my guess is, I don't know because they're not publicly traded, I don't have access to their financial statements, they aren't required to share that with me. My guess is though, if Union Tea had $10,000 in working capital, they'd be really happy that they'd be in a really good financial position because they're a small company. But what if I said Microsoft has $10,000 in working capital? Yeah, $10,000 is a rounding error for them. That's definitely not going to help them if something comes up that was unplanned, right? It's not going to cover an emergency for them. And so we need something beyond this measure in dollars. And the second calculation is what's on the screen right now, current ratio. You'll notice it includes the same two numbers from the classified balance sheet, current assets and current liabilities. But instead of simply subtracting and expressing working capital in dollars, it actually gives you the relationship or the ratio between the two. So same numbers, different calculation gives us a better sense because it's going to be expressed as a number of times, how safe are they? So for example, if your current assets were 10,000 and your current liabilities were 9,000, you would have, actually let me use a different number so I can do the math more readily seen. If our current assets were 12,000 and our current liabilities were 10,000, we would say we have working capital of $2,000, but we would say the current ratio is 1.2. We only have 20% extra, 20% on top of what we need to pay our current liabilities. So the current ratio is a little bit more useful because we don't need to know the size of the company. We don't need to know the numbers that went into the calculation to see, is that a good cushion? Is that enough extra? Now, anytime we are using a calculation like this, a financial statement analysis calculation, we have to keep something in mind. I'm going to write this on the screen for you. We need to compare our result to something else. So if I said the company has $10,000 in working capital, is that good? Your immediate reaction should be, I don't know, compared to what? Good compared to what? We need to have some standards of comparison. And for our purposes, I'm going to list 3, but we'll mostly talk about just 2 of these. So if you were a company and you were doing this calculation for current ratio or working capital, or last class, as we talked about operating cycle, I mentioned 3 other calculations that we'll learn about later in the semester. Receivables turnover, payables turnover, inventory turnover. All of those are calculations that help us also to answer these same questions. Is the company liquid enough? Is it profitable enough? Is it going to be solvent in the long run? So if you were that company, or you were trying to answer a question about that company, what might you want to compare that $10,000 in working capital. What might you want to compare that to?
To previous years?
Previous years, okay. There's absolutely no magic to my number 1, 2, and 3. I'm putting this as number 2 because that's how I think of it. So previous year, comparing ourselves to ourselves. Getting that historical perspective. There's a number of different ways that we can do this. Again, we'll talk about this more in chapter 14 at the end of the semester. But we might want to just look at 2 years, last year and this year, and see how did we do compared to last year. We might want to look at a trend analysis where we look at 4 or 5 years worth of data and see what's happening over, because we recognize right now we're hopefully at the end of a global pandemic, and for many companies that has had a dramatic impact, for the good or the ill, on their financial statements. So it might not just be enough for us to look at last year and this year because they were both kind of weird years for everybody. And so maybe we want to look at the last 5 years. Okay, so definitely we want to compare ourselves to ourselves, get that historical perspective. Are we getting better? How are we compared to last year? What else might we want to use as a comparison?
Other companies that are of similar size?
Other companies. So I'm going to leave the similar size thing for a minute. I'll get back to that. But other companies. So competition. Compare ourselves to our competition. And there's a couple different ways we can do that. We can look at industry averages, which works if you can identify the industry that you're in. So if you're an auto manufacturer, you're going to compare yourself to other auto manufacturers. If you are a restaurant, you might want to compare yourselves to other food service organizations. Sometimes that's not easy though, because sometimes you are a conglomerate. And if you are a conglomerate, it means you've got your hands in a whole bunch of different pies. And you might do pharmaceuticals and consumer healthcare products and food, I don't know. So then it becomes more difficult because you don't compare yourself to another conglomerate because they're not going to look exactly the same way you do. And so we may be happy with looking at an industry average if we can identify what industry we are operating in. But let's say you are already near the top of your industry. Well, are you happy just being better than average? If you're already in the top, if you know that you're in the top 10% of your industry, you better be better than average. And so you may use another process called benchmarking, where you pick one company and you say, how are we compared to that company? And maybe it's your chief competitor. Maybe it's whoever's number 1 in the industry because you're number 2 and you're shooting for number 1 and you want to know how close are we. Michaela suggested that we might want to compare ourselves to other companies of similar size. And yes, there's definitely something to that. I hate to keep putting us off to chapter 14, but in chapter 14, we'll talk about another process called common size. And there is a way that we can compare ourselves to companies that are not the same size. We might even use that for the historical perspective if something has dramatically changed in our company this year, so that the numbers we're looking at this year are much larger or much smaller than last year's. We may still use this common size approach to be able to compare and remove that impact of you're a much larger company. So if you're a startup tech company, you might want to compare yourself to Microsoft, but if you just look at the dollars, you're not going to compete on any level. But there are ways that we can look at percentages and ratios and remove the impact of absolute terms in dollars. Microsoft is ahead of us in every single category, but we still might have a higher profit margin or something like that. Okay, so those are definitely the two that we will be looking at and talking about the most frequently. Comparing ourselves to what did we do in the past? Are we getting better? And comparing ourselves to our competition. either one specific company or an industry average. The third one, which I list first in my head, is what's called a rule of thumb or a heuristic. A rule of thumb or a heuristic. A rule of thumb means we have a single number in mind. And in general, if we're better than that number, we're okay. And if we're not better than that number, then we might be in trouble. Or it's a red flag that, hey, we need to look at this more closely. There are not rules of thumb for every ratio or financial analysis tool that we have, because some of them are very industry specific. So I just mentioned profit margin. Profit margin is our net income divided by our sales or our revenues. And it's expressed as a percentage. So a profit margin that might be really good for a grocery store or like Walmart that runs, we phrase it, they run on very tight margins. What that means is they have very low profit margin. They might be really happy with 3 or 4% in a grocery store, where if you are a heavy manufacturing company, 3 to 4% is not going to cut it. So I don't have a rule of thumb for profit margin that's going to help every company. And if you are one of those, if you are a grocery store, you're going to want to look at the industry average, not some rule of thumb. But for some of the ratios, there are rules of thumb that tend to work for most companies. And current ratio is one of those. So the general rule of thumb or the heuristic for current ratio is 1.6 times. What does that mean in real terms? It means, if you think about the math associated with this formula, it means for every dollar in current liabilities, they have $1.60 in current assets. They have 60 cents extra for cushion, working capital, float, for every dollar in current liabilities. That seems like a pretty safe bet. They've got enough extra there to cover in case of an emergency, in case something comes up that they were not planning. In terms of current ratio, a larger number is better. So if your current ratio is 1.7, you're probably okay based on that general rule. And if it's 1.5, it's something we want to look at a little more closely. At minimum, it's a yellow flag, maybe red. It's something we need to look at. But it's a rule of thumb. It doesn't work for every situation. And so there are some companies that routinely run with current ratios much lower than 1.6, 1.3, 1.4, and they're fine because that's how they do business. And they're fine. There also, by the same token, could be companies with a current ratio of 1.8 who are in trouble. So that is really the end of what I wanted to talk about for chapter 4. As I said, we're not actually doing these calculations, but I do want you to be aware that they're out there, and we'll bring them all together at the end of the semester after kind of mentioning them in each chapter as they come up. Does anyone have any questions? Anything you want to talk about? All right, well, I'm going to stop the video.